Good morning, everyone. Welcome to Peterson Wealth Services Point of View. Today is February 1st, 2022. I'm Shaun Peterson. This is Billy Peterson. We're going to jump right into things here. So we're kicking off the first of the year, and we've went through a market correction on the S&P, the Dow, and the NASDAQ. NASDAQ even got up to 15% peak to trough. A correction is defined by 10% or more.
Started back in November, but it kind of continued into the first year and accelerated.
Yep, and I think people or investors kind of forgot that corrections are normal. We just haven't seen one since March of 2020 when COVID really started to take grasp of the world and the economy and the markets, and that was a very violent correction. I think we got as deep as 40% on the S&P, and it took about 30 or 45 days. But we want to just remind folks that this is part of investing. This is part of normal market cycles. So Kate's going to throw a chart up right now from our friends at American Funds. And you can see here, I'm jumping down to the kind of the bottom of this, that a 5% or more correction will happen actually about 3 times a year. And those last about 46 days. A 10% or more correction is going to happen about once a year, which I think will surprise a lot of folks. 15% or more will happen about once every 3.5 years, and a 20% or more correction will happen about once every 6.3 years. So you can look at that and think, those percentages aren't that big, but if you've got $1 million portfolio or a $2 million portfolio and you see a 10% drop, you're talking $100,000, $200,000, which can be a little unsettling to folks. But we're here to just remind you that that is just part of it. It's nothing to be up in arms about. Kate's going to throw up another one here, and I like to show this because it's what we do during those corrections that really matter. So the blue, the opportunistic investor, this is adding $2,000 every time the market dropped by 8% or more in a month. The gray line is just the buy and hold, so made no portfolio changes through the volatility. And then the gray square is the apprehensive investor, maybe the cautious investor that sold and moved $2,000 into, I'm going to just call that the T-bills cash every time the market dropped 8% in a month. And if you look over to the right of this chart, it'll show you the opportunistic investor has about $1.9 million. The buy and hold investor has about $1,250,000. And the apprehensive investor is left with just over $500,000. Keep in mind, they all started with the same amount, okay? So it's not like the apprehensive investor had less money to put in. They all put in the same amount. And so you can see from the person that added to it to the person that sold, about a $1.4 million investment difference. So really makes a difference what we do during those times, not what's happening during those times. And that's why, we're always comparing to indexes because it's kind of the easy data to get. But remember, our clients just aren't in S&P 500 or in NASDAQ or in Dow. We build diversified portfolios and we're investing. So when we see a lot of lead up, when we see things going on in the market, we're rebalancing, we're strategizing, we're taking moves that we think make sense going forward longer term. But we've seen some build up, and I think Billy's going to talk about that a little bit, and maybe some things that we've done prior to this and why we do it, because we're trying to minimize risk in portfolios.
Right. People have a lot of concerns. Every time we see a correction, we start to feel that. You feel that in your gut, like, oh no, maybe I made a mistake. Something's wrong. People know things I don't know, and that's normal reaction. It's human nature. Risk becomes apparent in your mind when you start to see the values drop. We always go through this risk tolerance profile with clients and talk about, are you comfortable with a market decline? Oh yeah, I'm good with it. I'm good with it. The market's going up, and you don't hear from them, and then all of a sudden it goes down, and they might not be as comfortable as they thought they were. But really, like Shaun's point, I really want to drive that home. What you do during a correction sets you apart from everyone else. It's what makes a successful investor versus a poor investor. The poor investor is not an investor, really. They're just part-time trying to get in for the ride, and then it gets a little rocky and they want to jump out. So it's when you start seeing that unease and that nervousness and that gut check, it's when you do that and you actually go against the herd and you go into the market and you buy when others are fearful. That's when you make yourself completely on a different wavelength. You turn things into your favor. So always try to turn the market into your favor if you possibly can. Take advantage, charge in, attack. That's when things are on sale and better. Always staying diversified. We're not trying to tell you jump into things that are a huge amount of risk. And we're going to talk about that for a second here today as well. Is there's stuff that doesn't make sense. Okay, the meme stocks over the last 2 years. We told you, Kay's going to show you a video, and we're going to tell you just again to avoid those types of things. So here's maybe a clip of that, if you can either put that up or a link. And secondly, we're going to talk about the crypto craze that we've seen over the last 10 years or so when they started inventing things like Bitcoin and Ethereum and others. Now there's thousands of them. And we tell people, and we're very cautious about that, not telling you that it's not here as a utility. It's something that you can use like a credit card. You load up your Starbucks card with dollars, right? Yeah. And you go to use it at Starbucks and you buy your coffee. Well, what would happen if that Starbucks card was worth, you put $1,000 on it, it's worth $10,000 that afternoon, and then go back the next morning and it's worth $50.
Not fun.
It's really serious. I mean, star athletes, people all over the television, media companies are bringing out these experts to tell us all how they're trading and making tons of money, millions of dollars. Athletes like Odell Beckham Jr., I think, was taking a big portion of his salary in Bitcoin, and that happened November of last year. Just FYI, to back that up real quick. If he did take a percentage of that salary, I think it would have been $750,000 of his salary in Bitcoin. It's worth about $35,000 today. So we're trying to tell people there's no reason for these poof out of thin air type investments. I don't even call them investments. These are crapshoots. These are speculation at its finest. It's not an investment. These aren't how things work in the real world, okay? And there's going to be a day of reckoning. We're going to sit right here and tell you right now, almost all of these are going to come down to earth. And, well, I say all of them. I don't think there's any real significant value in any one of these that says it's substantially worth more than what you paid for it, or what it's going to do for you. Potentially just an exchange or a medium of exchange. To buy and sell on the internet. Now we're getting into regulations. Companies that are starting up and creating new cryptos are going to be regulated by federal authorities. The U.S. has now said they're going to start cracking down. People that lose a bunch of money, guess what they do? Start barking to their House members or representatives and telling them they're losing money and they want it back. And so then the representatives come riding to the rescue, and they're going to start talking, giving press conferences about how we need to take care of these investors. So more regulation coming. Say that. Safe to say, more regulation coming.
I think the best analogy there is we view the cryptos and the memes and things like that. It's gambling. It's not investing. And we've said this before. Investing should be boring. It shouldn't be getting in and trying to get rich quick. If you're hearing that, yes, there's people that have done it, but they rolled the dice and they happened to hit. But most of them rolled the dice and they crapped out. They sevened out. So that's our point on that. And we're looking at more quality investments that have products, that have earnings, that have buildings, that have employees, that have development teams. That's what we're investing in. We're not just investing in the next rage or the next fad.
It takes time to build something of value.
Okay? It does.
There's no free lunch. There's no easy road to victory or success. So y'all know that. You know it in your mind and in your heart. And just follow that. All these people that want to run to that side, that's the craze and where the herd's going. And we're just trying to caution people right now because we're getting a lot of calls. That's why we keep mentioning in these videos. So many people are asking about that. We want to get in on that. We're hearing about it. Our son's doing it. Our nephew's doing this. And then all the star athletes and the media companies, they're all over. CNBC, Fox News, CNN, it doesn't matter. They're all bringing them out because it sells and it makes money for them. So it's all over the place. Just remember, we've examined all that, guys. It's not something that we would advocate. $1.35 trillion has disappeared from crypto. The values have dropped by $1.35 trillion since November. And the meme stocks, the values have dropped by $191 billion since the peak of February. So AMC, GameStop, Peloton, all these that were part of this craze, and these smart people that are all over Reddit and telling you what to buy, and they're gonna disrupt the market, and they're gonna make it all make sense now. They've got to figure it out. Completely crushed. You don't hear a word from them anymore. Where'd they go?
I wish they'd bring them back out, but I don't think they will.
I'd love to get these guys back on TV right now, or have them come in and talk to us about what happened. Really, where'd all those values go? So Kate's going to put up another chart. I'm going to talk about inflation for one more time because we know that's a big problem, and we're trying to offset that. In our portfolios, we kind of saw a correction coming as you're if you listen to our videos regularly, you heard us say that correction is necessary. We want to see one. We want some of this excess to flush out. And now we've gotten one, and we're kind of here waiting, really ready to pull the trigger when we see this big kind of a cataclysmic event that will send the markets with big volume, another fairly good drop, and then some stability. Now, we may have already gone through it, and maybe correction may be over for right now. There's more to come. Probably this year we might see another one. But I'm going to say this. Usually you see a pretty gut-wrenching event to take the markets down when no one wants to invest. Okay, no one wants to buy them because that's when they're at their highest level of anxiety. They think it's bad, something's wrong. Their friends are telling them to get out. They say, "I told you so. You shouldn't have ever bought. Should never be an investor." Yet, being an investor has been one of the most successful things you can do if you stay put over the long haul. Okay, stay put over the long haul and have hopefully professional advisors helping you guide through this, make small changes to your portfolio allocation as you go through these different environments. So here's your chart on the different asset classes during an inflationary environment. When I say inflationary environment, I don't really mean this chart's comparing to inflation. It's comparing it to Fed rate hike cycles. So every time the Fed has been in a cycle of raising interest rates, which is where we're going right now, believe me, we're going into a cycle where they're going to be raising rates for some time to come, probably 2 or 3 years to come. And we want to show what's performed well during those environments. As you can see, the best performing area is S&P Global Commodity Index. And that's your commodity funds. That's what we've been adding to many of our models. We've been talking about it for a while. That's averaged 19% a year during those environments. The Emerging Markets Index has averaged 16%. On down the line, you can see the worst performing areas have been anything related to bonds, cash, fixed income. And we talked about that many times. Those are areas to avoid. Those are areas that are very expensive right now and look like they're going to have a lot of trouble trying to navigate through. Remember, cash is you're sitting on cash and you think that's a good place to be, but yet go to the grocery store, go fill up your car, and everything's up twice what it was last year. I mean, not twice, but you know the idea. We're up at least 7% in most areas, and some are 10 or 15%. Transportation costs, all those things are coming in, and we're having to feel that pain. So your cash is actually losing value.
You got to look at a real return. Inflation minus your rate of return. So your rate of return on cash is, I would say, is 0. So we're at a negative 7% return, and we think that is underreported. I think inflation is probably higher than 7. I would call it more like 10%. So we're trying to just advise people, make your money work as hard as you work to earn it. And if you're retired and you're trying to keep up with costs, you know, it's not like you can go buy a CD at a bank and retire off that interest, or you could go buy a 10-year treasury bond at 1.8% and retire off that interest. So the money is flowing into the markets, and it's a good thing. I mean, you know, it's a good thing. It's prices are going up, and companies, their earnings are keeping up with those prices right now. So we're seeing a lot of positive things in the market. Just because we've seen this latest correction, just because we're hearing about inflation, doesn't mean that we wake up and poof, one day this is all gone.
This isn't crypto.
This isn't like that. So people still wake up, they still go to Walmart, they still go to Home Depot, they still go to their bank, they're still buying products. So we're in a good environment. Now the debt, I think we'll be talking about that, the U.S. government debt. We'll be talking about that more and more in our videos because that's going to rear its head at some point. But right now the economy, the United States, is flush with cash.
There's a couple of things that we are watching, just to wrap this up.
Yep.
We are watching how fast the Federal Reserve is going to raise rates. That's going to be on everyone's mind, how quickly they're going to start raising rates. As we all know, hike of interest rates equals less profitability for most companies because they're borrowing a lot of money usually to make ends meet out there. So, and it makes it tough on some small companies. So we've taken some liberties here in our portfolios. We've moved away from some of that. We have a higher level of cash in most of our models than we've had in many years. And we're just waiting for the opportunity to put that to work. So we're talking with clients, telling them, hey, if you have some extra cash, good time to be getting it ready, getting it into your accounts right now. We're going to be deploying that. We've been talking about it. We're watching. We have an idea what we're looking for. The other things we're watching for are what comes out of this Russia-Ukraine situation, an escalation of war. If Russia invades, goes across, if we have an escalation, if we have other countries now getting involved, that's something that would probably send the markets down, at least temporarily, until there's stability. resurfaces. The inflation again is always on people's mind, but back to policy and what the government's going to try to do. We've got midterm elections coming up this year. A lot of the market is future or forward looking, so it's going to be looking at some of these races and different folks who are going to be running for office, and what kind of policies or what kind of ideas they have for the economy. So all that comes into play. There's going to be more volatility this year. I would just get prepared for it and plan on it. Doesn't mean the market's bad. Just means opportunistically, the folks who are investing and regularly putting money to work are going to have a pretty good year. There's going to be pockets where you can get money to work and it's going to pay off, in our opinion. So be prepared for that. Also, just one thing on the videos, we added some new mics here, thanks to Cade. So we want to make sure that you guys are hearing us better. We've had some comments that you couldn't hear us as good. So would you please comment? We love getting your feedback on these videos and what you think of them, from not only the content, but the clarity and the sound, the audio. So please let us know. We'd like to hear your thoughts and keep it coming.
Thank you.
Appreciate you out there. Take care and talk to you next time.